everyone, welcome back to Investing Sucks. My name is Eric and thank you so much for tuning in. So today we're going to talk about Brookfield Asset Management. This is a very prominent company in the TSX. They're currently worth about $100 billion in Canadian market cap. And I figured it'd be worth me taking a look at this company because this is a very prominent company that a lot of people talk about when it comes to companies that you'd want to buy and hold forever, really. Kind of one of those long-term compounder companies. So as always, we'll go over who this company is, we'll talk about their growth prospects, look at some valuation metrics, and then look at 7 years of financial history and then see if we can project a valuation and see what kind of return we could expect if we buy this stock today at its current price and hold it for about 7 years. But before we get into any of that, if you are new to my channel, I would greatly appreciate it if you would consider subscribing. It turns out only about 14% of the people who actually watch my videos are subscribed to the channel, so please, if you do find these videos useful and you like this type of content, then please consider subscribing to the channel. It really does help me out tremendously. And of course, you can always just change your mind later. But without further ado, let's actually get into the video now. And as always, we'll start by looking at some basic valuation metrics for this company on Morningstar. Okay, so here we are on Morningstar. We're on the valuation page and it gives us a whole bunch of valuation metrics. And why I like looking at Morningstar is because they actually give you the trend of how these things have changed throughout time, really. So they give you a 5-year. They also compare it to the index, as well as, give the last few years. So if we start by looking at price to earnings, they have no PE in 2020 because they actually lost money in 2020, and currently they have quite a high PE at a 63.5. But really with this PE, which we're going to talk about later, you don't really want to look at PE for a company like Brookfield just because of the nature of their operations. They own a ton of assets, and these assets are all investment style assets, which means they're constantly revaluing them. And every time they revalue those assets, it gets flowed through into the income statement, which then affects their earnings. So really what you want to look at is cash flows. It's a lot more stable and it makes a lot more sense for a company like this. So pretty big disparity when you look at their price to cash flow. So it's a lot lower. So they're definitely more reasonably priced when you look at cash flow, and you can see it's pretty consistent throughout time. I mean, it's historically pretty high compared to the last few years, but overall it's not too bad. And then price to book, it makes more sense to look at price to book for a company that owns as many assets, versus like a software company where they don't really own that many assets and their price to book can be extremely high. But it's pretty reasonable here, nothing too crazy, just kind of in that 2.5, below 2 range there. So Brookfield Asset Management is definitely a more difficult business to kind of understand. There's a lot of different businesses that they own and funds that they operate. They have stakes in some of their own funds as well, and I'm sure you guys have heard of other funds out there other than just, say, Brookfield Asset Management in terms of it being a stock, but also maybe Brookfield Infrastructure Partners, Brookfield Renewable Partners, Business Partners, Property Partners. There's many different funds out there. So there is quite a lot of different moving parts, and it makes them very difficult to kind of understand them because there's just so much. They're such a huge company, there's so much going on, and really if you tried to understand absolutely everything about this company, that would probably take you days upon days, and if I tried to fit it all into a video, the video would be hours long. So that's not really the goal of this video. The goal of this video is to give you guys enough information to decide whether or not you think that Brookfield is a company you want to look into a bit further. Again, just based on looking at historical data, learning a bit about kind of the tailwinds that exist in the industry, as well as a valuation, which I'll get into later. So Brookfield Asset Management is really broken down into 2 main lines of business. So you have their asset management side of their business, which is when they operate these funds, these investment funds that they give to their clients. So that could be sovereign wealth funds, individuals, institutions, that type of stuff. And then they earn performance fees and management fees based on those funds. So if the total assets under management tends to increase, then the amount of fees that they can earn will increase as well. And then they also have what they call invested capital. So what this is investments that they themselves have made. So these are investments that will actually appear on their balance sheet. And the whole point of that is to ensure that they have a vested interest along with their clients. So they're not just creating these funds and then selling them to their clients. They're actually putting their own money in these funds themselves, which is definitely a good thing to see an asset management company do. So to give a better picture of this, I went to page 21 of their 2020 annual report, and we can see the split up of how what they've called a fee-bearing capital. So fee-bearing capital, it was around $312 billion. And it's the total amount of basically capital that they've invested that they're eligible to earn fees on. So we can look at it how it's split between kind of the different types of investments. So there's long-term private funds, 44%, that's this part here. So a very big chunk is actually not even available to buy in the public markets, which is what perpetual strategies would be. So perpetual strategies makes up 33%. that is the the Brookfield Infrastructure Partners, Brookfield Business Partners, Property Partners, all that type of stuff. Other funds that a lot of people in Canada are invested in. And then we got this other part here. And then over here gives a split up of how we can see it's diversified across different asset classes. So 17% real estate. Infrastructure is another big one. They're very heavily invested into infrastructure. Private equity is only about 6%. Renewable power, a lot of people are probably looking to invest in renewable power because that's kind of a general trend that's going on. People are switching away from kind of the traditional oil stocks into companies that are moving more towards renewable power. And then credit is a very big one. So credit strategies, that's actually mainly through, I think they own about 62% of another fund called Oak Tree Capital, which Oak Tree Capital is operated by an individual by the name of Howard Marks. He's a very prominent value investor, has a very good record, and they've invested in a lot of things like credit, so that'd be corporate bonds and kind of items of that nature. And then if we scroll down a bit, remember before I said the other aspect of their business is invested capital. So here it says we have approximately $58 billion in invested capital on their balance sheet. And then it gives some key attributes of the invested capital, which I won't go into, but if you are interested, you can find it all in their annual report here. So that's just a quick brief overview of those two lines of businesses. So like I said before, Brookfield owns many different assets across many different funds, across many different regions in the world. They're really a global company in that sense. So understanding every single asset they own is really outside the scope of this video because it would just take way too long. But what you should know is that the fees that Brookfield Asset Management will earn, which would then lead to more revenue, more cash flows, more profitability overall, are all dependent on, for one, how many people are invested in those funds and how good the funds actually perform. So if you own Brookfield Asset Management, you also indirectly have a stake in Brookfield Infrastructure Partners, Property Partners, Business Partners, Renewable Partners, all those other funds that are pretty prominent ones that a lot of people look to invest in. But if you own Brookfield Asset Management, then you own kind of a blend of them, along with, as we saw, many different other private funds and credit strategies, various different types of stuff. So you are very diversified. Now, all of these assets are kind of focused on what they would call alternative asset classes. So not your typical assets like stocks type of thing, but things like real estate, renewable infrastructure, all those different types of things. So you're not kind of diversified across a whole different type of or whole bunch of asset classes, but you are diversified within alternative asset classes. And I think there is pretty good reason to think that alternative asset classes are due to perform pretty well going into the future, just because we've been in such a low interest rate environment for so long now, and it's likely going to stay that way for at least the next year. I mean, depending on what the central banks decide to do, which could take a while to fully figure out what will end up happening there, but there is definitely opportunity for these asset classes to gain more interest. So what you would want to see as an investor is you want to see, for one, these foreign funds actually performing well, so the assets do well, overall the market value increases, and you want to see more investors flocking towards these funds. So let's look at one section of their annual report to see if there's actually evidence of that. Okay, so as I said before, they have about $312 billion in fee-bearing capital. So that's what this number here is. That's the total amount of fee-bearing capital. And what it shows here is the balance as of December 31st, 2019, compared to the balance as of December 31st, 2020. So basically all the changes that happened throughout the year. And what this allows us to do is it allows us to understand how well these funds are performing. Now, they have it broken up into many different ones. So long-term private funds. This one might be a bit harder to find actual information because, they're private funds, they're not publicly listed. Perpetual strategies, this is, as I said before, property partners, infrastructure, renewable partners, all that type of stuff. So we can see that had a pretty strong change there, about 15.4 billion. A lot of it was due to kind of the increase in the market valuation of the perpetual strategies, as well as inflows. So you want to see both those things, market value go up and inflows go up, specifically inflows higher than outflows. And then credit strategies, so that, again, that mainly relates to their investment in Oak Tree Capital, which is that fund that's run by Howard Marks. That also had an increase, but there were decreases here. So this would be worth investigating to kind of understand why that was, and also maybe go back and see if they've provided this information in previous years. And then make sure, if you are invested in this company, constantly look at this information to make sure that it is growing. But overall, there was a positive change of $21.8 billion. So that's definitely something you want to see. You want to see this number, fee-bearing capital, go up, because that's how you're going to make your money on this investment. by just seeing the amount of money that they can earn fees on increase at a fast rate. Okay, so we've talked about a lot of positive things related to Brookfield. Now, in order to provide a balanced discussion, we do have to discuss some things that are negative. So one thing that was negative was their revenue from 2019 to 2020 actually went down. And a big reason for this was because of poor performance across their commercial properties assets. So if we go look at their annual report, we can actually get more information on this. So if we go to page 60 of their annual report now, this gives us a bit of details kind of how their commercial properties perform, specifically in the Brookfield property fund. So we can see their revenue was down. It went from about 8.2 billion in 2019 to about 6.6 billion in 2020. And then down here, what I've highlighted, it actually details the reason why. So it says the decrease in revenue from closures related to the economic shutdown, lower occupancy rates in our hospitality assets. So those definitely would have gotten hammered last year. A decrease in parking income and lease expirations in our core office portfolio. So that's one of the big reasons why their revenue was actually down, was just really due to kind of poor performance across some of their commercial properties, among other reasons, but that was one of the main reasons. Now, Brookfield Property Partners is actually going to be taken private. So Brookfield is going to buy all the outstanding units of this fund and essentially just make it private. And the reason they're doing that is what the CEO said, is because they think that these assets are just way too undervalued and people are treating them as if no one's ever going to step foot in these assets again. So, and to be honest, I kind of agree with him on that. So I do think this will be a smart move for Brookfield. Obviously, that remains to be seen, but it kind of shows the point that when you're investing in a company like Brookfield Asset Management, really what you're investing in is their investment track record, right? It's the management team. It's their ability to find good investments, buy them at good prices, and generate long-term compounding returns. That's why you'd want to buy a company like this. Okay, so now let's look at 7 years of financial history for this company in Excel. Okay, so here is 7 years of historical financial data for Brookfield, and these are all in millions of USD, by the way. So they do report their numbers in USD, so all the data you see in Excel will be in USD. So I've got 2020 over here, 2014 here, and we can see their revenue has grown very significantly. As we saw before, their assets under management, their fee-bearing capital was all growing quite fast, and we see an even faster growth rate kind of in their revenue. So the compound annual growth rate of their revenue for this period was 19.2%. Now, for a company that is as big as Brookfield, that is very good revenue growth to see, and it's a very positive trend. Now, I did include net income here, but and as you can see, there was a loss that they had in 2020, but really net income isn't a great measure for this company because you can see it fluctuates a lot, right? Like you can see down these years, then all of a sudden it's up a lot, then it's down a lot. It's just because the nature of their business and the assets they own, they are investment properties. They're constantly revaluing them, and all those revaluations hit their income statement, so it kind of skews the net income number a bit. Now we'll move on to cash flow from operations. So cash flow from operations has grown a lot more stably. So 2.5, 2.8, 3, 4, 5.2, 6, and the most recent year, $8.3 billion in cash flows from operations. We deduct capital expenditures, and these have been growing, so there is an upward trend in capital expenditures. Specifically last year, they spent a lot, but they had such high cash flow from operations. We can see that their kind of free cash flow, if we just look at it as cash flow from operations less capex, is still growing at a pretty substantial rate. You know, primarily driven from their cash flows from operations going up so much. And I have all this other stuff here if we want to determine free cash flow to equity, because when you're calculating this, you also have to take into account the effects of debt that they issue and preferred shares that they issue. That's just how you calculate this number. So I have the debt issuance and payments. So they have been issuing a lot of debt kind of throughout the years, quite a lot in these years. And then they also have preferred shares. So this doesn't really have that much of an effect. You do have, but when you're calculating free cash flow to equity, you do have to deduct any preferred share dividends, so that's what this is here. And then you add or deduct any issuance of preferred shares or any kind of paying down of those preferred share amounts. So it was zero in 2020, but there have been some amounts here. But overall, not a huge effect. So free cash flow to equity, we can see it's pretty strong, huge these years because of the debt, but in the most recent year, it was about 8 billion. So, and then if we divide that by, or if we take that as a percentage of revenue rather, we get about 30%, but free cash flow as a percentage of revenue, excluding all the debt effects and the preferred share effects, historically it's been about 16%. So that's pretty solid. Okay, moving down more, we got shares outstanding. So shares outstanding is going up, but not really by a whole lot. Over here, it's just a 1.2% increase in shares outstanding. I mean, that's essentially nothing really. That's not really anything to worry about. It is dilution, but not a whole lot of dilution. So you can just see very gradual increase there. Free cash flow per share. The whole point of this is to calculate free cash flow yield. So how much free cash flow are you getting for each share that you own in this business? And keep in mind, this takes into effect all the large debt issuances we saw, because it is free cash flow to equity, which you need to include the debt issuances when you're calculating that. So it is kind of skewed high in these years. But I think if you look at it in 2020, 13%, that's a bit more indicative of what you can expect. But as a median, this number here is taken as the median just because I don't want to take an average when you have these years that were skewed high so much. So as a median, free cash flow yield is about 23%. Now they do also pay a dividend. So we always want to make sure that dividends that a company is paying is safe, so they can actually afford to pay those dividends just with their free cash flow less their capital, or their cash flow from operations less their capital expenditures. And we don't want to see them taking out debt just to continue to make dividend payments. So their dividends, as we can see here, are extremely affordable. They're not using so much of their free cash flow to pay dividends. Really, the highest it ever was only about 30% here, and historically it's usually kind of in the 20-15% range. Which for a company like Brookfield, I would honestly rather see them do that. Because remember, with a dividend, it is a net zero transaction, right? It doesn't create any value, it doesn't destroy any value. And if Brookfield as a company has investment opportunities that they could pursue that would lead to, a $1 of dividend being paid out, instead of just paying it out to the shareholders and it kind of staying at $1, they can reinvest it, turn that $1 into $2 down the road. I'd much rather have that, because that makes them more of a long-term compounding type of company. Okay, so overall, very impressive 5-year financial history. There's a lot of positives in there that we saw, right? We saw cash flow from operations going up, revenue from going up, even earnings to some extent going up, but as I said before, that's not really a reliable metric. So now let's take all these historical growth rates and historical free cash flow as a percentage of revenue numbers and put it into a IRR calculator and kind of determine what type of a expected return we can get if we buy the investment at their valuation today and hold it for, say, 7 years. Okay, so here is the valuation model. As always, for a company that has a strong history of producing positive free cash flow, I use the free cash flow to equity model. Now, here are my assumptions here. I kept things very simple. So revenue growth is at 15%. So 15% for 3 years, and then I'm going to assume it tapers off to 10% for the next years. Now, we saw historically for the past 7 years, their revenue grew at a compound annual growth rate of about 19.2%. But since it is going to get more difficult to grow as a larger company, and plus we want to make this model more on the conservative side, I assumed lower growth rates than what they've historically been. And also, just kind of as an asset management company, once you reach a certain size, it's harder to deploy capital because there are only so many investment opportunities out there that would meet your requirements for it being a worthwhile investment for you. So I think these are reasonable assumptions. Maybe they're a bit too conservative, but overall I think they work for this model. Now, share growth / buyback rate, I assumed 1.2%, which is exactly what it's been historically. Now, if we look at free cash flow to equity as a percentage of revenue, as we saw before, if we're just looking at free cash flow, excluding the effects of debt and what they decide to do with their preferred shares, because those are kind of unpredictable. So if we're just looking at free cash flow as it's defined by cash flow from operations, less their capital expenditures, and then take that as a percentage of revenue, historically it's been about 16.2%. So then this allows us to calculate free cash flow to equity, which is what we have here. So it is going to grow because it grows kind of in tandem with the revenue growth. So this is our stream of cash flows that we can expect to get. And then prorated for the percentage of the year, since we're halfway through 2021, we only get half of the year's free cash flow. And then down here, shares outstanding. Again, I just assume that this is going to grow, at a 1.2% rate, which I think is fairly conservative. So then we get free cash flow to equity per share, which is just free cash flow to equity divided by the amount of shares outstanding. So then we get this stream of kind of cash flows here. So this stream of free cash flow to equity per share is really what you're investing in, because what they can do with it is they can use some of it to dividend it out. They can use it for a further growth initiative, so make more investments in the future. Just whatever they decide to do with it, it does belong to you as the shareholder. That's why you're investing in them. So that's what you get as part of your investment. So let's put all these into an IRR calculator now and see what type of a return on investment we can expect. All right, so here is the IRR calculator. Now this is all in USD. So this is if you were to buy the shares on the New York Stock Exchange. So they're currently trading around $54. So you would purchase the shares today in USD at around $54. You would then get this stream of cash flow, which is the free cash flow per share. Remember, as I said before, they can do whatever they want with that, right? But whatever they just choose to do with it, it will increase the value of their shares. That's the value you get. And then sell the shares at the end of 2027 for around $60. But obviously we also get this stream of free cash flow to equity per share. And the way I calculated this was taking their historic, or kind of the median free cash flow to equity yield, which we calculated above. So with all those assumptions in place, we get an IRR estimate of 17%, which is a strong IRR. That is historically a market-beating IRR. Really, when you see an IRR above 15%, that is intriguing. That makes you want to research this investment a bit further, learn more about this company, and see if it is right for your portfolio. Okay, so a 17% IRR. Now, let's just briefly recap the assumptions we made in order to get this IRR. So we assumed that their revenue growth for the next 7 years is going to be lower than it was for the previous 7 years. We also assumed that their free cash flow to the equity holders as a percentage of their revenue is going to be exactly what it's been historically. And we assume that their shares outstanding are going to grow at the exact same rate that they've been growing historically. So to me, these seem like very reasonable assumptions. You know, they're not super aggressive, they're not super conservative, they're kind of in the middle. And with those midline assumptions, we get an IRR of 17. I mean, this almost feels like a blessing because we're currently in a stock market where it seems as if basically every company has the next decade or 2 decades of earnings already priced into their valuation. So to be able to find a company like Brookfield, a high quality business, at a decent valuation where you can actually expect, based on historical growth rates, to earn a decent return on your investment for the next 7 years, this is definitely an investment that I think is worth looking into a bit more to determine if it is right for your portfolio. But what really impresses me about Brookfield is their resiliency. I mean, they're an asset management firm that's been around for over 100 years, which means they've been through the highs and they've been through the lows, so all the market ups and the market downs. So they've shown resiliency. We know that that's a part of their business model. They have a very strong culture and they're very disciplined in how they allocate capital. I mean, they wouldn't have been around for over 100 years if they didn't have a super disciplined approach. So in my opinion, just being able to put your money to work in a company like this, by definition, just makes it a rather safe investment. And I think it's a great way to kind of just park your money now. And like people have said, it's definitely one of those investments that you can just buy now and hold forever. But I'm sure there are people out there who have alternative viewpoints. So maybe I've missed something and maybe you think there's something that needs to be pointed out that I didn't directly discuss. So if there is, make sure you leave a comment. I promise I'll read it. So any comments you have about this video, just drop them down below and I can get back to you. But anyways, guys, that pretty much does it for me. So once again, thank you so much for listening to my analysis. I hope you did enjoy it and you found it useful. If you did, please subscribe to the channel and also drop a like on the video. Both those things help me out tremendously. And with that in mind, I'll see you in the next video.